The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is analyst Mickey Modek. G'day, Mickey.
Hi, Gaurav.
You've got that dog under control? No more barking, tail wagging,
I
drooling?
wouldn't say under control. I've bribed him with a bone, so he seems to be pretty occupied.
Okay, that means we've probably got, 30 minutes or so before he's finished?
Yeah, that sounds about right.
All right, we better kick on then. And with us also is analyst James Carlisle. Hey, James.
Good afternoon.
Yes, no loose animals in your house, I assume?
Well, I've thrown my new dog out in the garden, so hopefully that'll keep him happy for a little bit.
Okay, well, we'll see how we go. Any barking or drooling, you'll know it's either Mickey or the dog. Let's begin with reporting season, gentlemen. And we've just finished it up this year. We wrote a little summary of it on the website. And I think the general consensus was that it was a harder reporting season than average, but also probably better than what many people had expected, and certainly better than what most of us had expected, I think. JC, what do you think about it?
Well, I think it was definitely better than expected. I think the funny thing is that the real disaster situations we'd been kept up to speed with pretty well because they'd raised capital or they'd warned and we knew exactly what to expect from the real disaster situations, but because I suppose everyone was tending to be quite, the company managements were tending to be quite conservative. They probably, some of the ones that had done quite well out of all this, perhaps hadn't kept everyone abreast of how they were going. So there were a few surprises on the upside with companies that were actually performing quite well out of the pandemic, from everyone being at home and all that sort of thing.
There were a lot of very large moves up in particular, and I don't recall too many big moves down, but lots of, you'd wake up and see a company up 10% plus in a day, which...
Yeah. I mean, probably the biggest move down was Seek, I suppose, which fairly early on, they came out with one of their scenarios, which they painted a fairly gloomy scenario for the next year. And the market, that was worse than the market was expecting. But again, they're probably being quite conservative. I mean, there's nothing in it for managements to be aggressive with their forecasting at this stage of the game, I think. So anyway, the market took them at their word and sent them down about 10%.
Mickey, how did you see it?
Yeah, no, I agree. I mean, it was funny. I guess you kind of, towards March, well, going back before March, I think most of us were probably not as worried about the pandemic. And then I think around March, probably got much more worried about it. But by then the prices had already fallen so much. But I guess to JC's point, just on the conservatism, it's funny how quickly management becomes conservative, and then as an analyst, how conservative your own estimates become. Instead of estimating, this thing is going to grow, when you're maybe guessing what earnings are going to be in 3 years, you just slash everything and go, what's the absolute worst case scenario? And I think everyone's doing that en masse, and that's how you kind of ended up where we were back in March. And you just forget to think about, I think you forget to think about the sources of upside, and you forget to think about, which businesses are actually benefiting, because you're just in this mindset where you're thinking really only about what can go wrong.
It reminds me also that every investor really looks back to the last battle to see how this one might play out. And I remember we were doing it and everyone else was doing it too. We were looking at the SARS breakout and finding analogies with that. Yes, it's going to be painful for a couple of months. Travel-related stocks seemed pretty obvious to be hit hard. But I don't think anyone imagined we'd get to the situation we're in now. No one was even contemplating that. I don't think. I think
lockdowns was the thing, wasn't it? I think in February, early March, people were imagining a pandemic and a pretty nasty sort of scenario. But I don't think anyone really imagined that there'd be lockdowns and borders would be closed, and
Yeah.
so that's really obviously had a massive impact on various stocks.
I guess there was a
And
few
with,
people, but yeah, it wasn't.
well, look,
It wasn't us. I don't think.
yeah, well, yeah, okay. I
But
mean,
what
it's never
happens when
been
we?
done before, has it? You see, I mean, so that I mean, look,
There was
yeah.
no precedent.
There was no precedent. I think that's right. So,
I,
I mean, people did anticipate it. I suppose some did, but that would have, I think that was quite brave. But anyway,
I
that's how it
remember
turned out.
after 9/11, I think insurance for terrorism just went through the roof, and all these companies had to have disaster recovery plans and plans for a big terrorist outbreak. Especially in the US, that was the done thing now. And what that tells us is that once an unprecedented event kind of happens, it gets stuck in corporate memory, and people start planning and preparing for it next time as well. So it
Mm.
makes me wonder, now that we've got a pandemic situation kind of under the belt and we know it's possible and we know what it looks like, even when this is all over, do travel related stocks just go back to looking what they used to look like? Does Sydney Airport still carry as much debt? Do banks lend under the same scenario? I mean, there
I think
could be some.
definitely not. Definitely
Yeah.
Mm.
not. I mean, Sydney Airport quite clearly will have to keep enough liquidity to go a couple of years of lockdown. I mean, there's been what, four serious pandemics in the last 100 years.
Wow.
18, 57, 68,
Mm,
and then now.
mm,
So you might anticipate every 25, 30 years
mm,
on average. But of course, the ones 57, 68, they were 10 years apart. We could
mm.
have another one of these in 10 years' time. And, companies will had better make sure they're ready for it.
I wonder though as well. Just having watched Bill Gates, talk about this before it happened. I guess warning everybody about it. And in that speech, he kind of talks about how pandemic preparedness is sort of like having a military on standby, and
Mm.
it's just about allocating a big, government budget to that, kind of having people on the front line being really well prepared, and that could potentially help limit the impact. I mean, this time around, we were pretty much totally unprepared and didn't take it seriously,
Yeah.
because it was, but next time,
Mm.
I wonder how much of a difference that makes.
Well, I
Yeah.
think for years we've been cutting health budgets, haven't we? Because everyone wants to pay less tax, and so that's been a target. And so I suppose what this tells you is you need to have some redundancy factored into the system. It doesn't matter if your health system isn't operating at capacity, because it's going to have these situations thrown at it.
It
And at
reminds
least
me.
for a few decades, we might go with that. But then eventually, I read somewhere that 3 years ago, I think the UK sold down their emergency pandemics
Yes, that's
stock
right. Yeah.
of PPE equipment,
Mm.
because they finally thought,
It's never going to happen.
pandemics, yeah. And then,
Yeah.
so I guess eventually the memory sort of fades, doesn't it?
It,
But I
re-
mean, let's hope not.
it reminds me, I've got a friend who lives in a fancy waterside suburb, and he's been really lax on security because he lives in a nice area. He knows all his neighbors. He doesn't, I mean, locks his doors, but he doesn't have any sort of external security. And one day got broken into. And after that, 2 or 3 days after that, his place was like a fortress. There are cameras and bars everywhere. And of course, he's never been broken into again. I just wonder that, once your level of preparedness has been shown up as being lax, that really only happens one time, right?
Mm.
After that, you learn your lesson and you prepare. So I think all of Bill Gates' suggestions are undoubtedly going to be taken up. The level of international preparedness is going to increase, and I don't know, maybe the probability of this happening again is actually going to be lower. I mean, imagine what would
For a
happen
while,
for a while.
but if
Yep,
it's another 50 years before we have a serious pandemic, as it has been since the last one,
yep.
then people forget, don't they? Probably.
Yeah.
They do. Yep, yep. Still, better 50 years than 10 years, I say.
Well, I mean, this is this is the uncertainty, and so that's why. I mean, I think previously, so 2 years ago, 1 year ago, people weren't factoring lockdown. People still had in mind that it was possible to have a pandemic. We've
Mm,
had, but I don't think anyone factored in the possibility of being told to stay in your house.
yeah.
And that's a change. And I think business plans in future will have to factor that in. If you want to start up a small business, you have to go along to the bank,
Yeah.
and the bank's going to say, well, what are you going to do? If there's a
Yep.
lockdown, and you'll have to make sure you keep enough cash on hand, and you'll have to, you'll probably have to pay a slightly higher interest rate. I mean, all of these, it's a major long-term impact, I think.
And one of the things that we do in our household now is we always make sure we have a redundant toilet paper supply because you don't know what's going to cause everyone to just freak out.
So it was you, Gaurav. That was...
I wasn't prepared before, but I am
yeah,
prepared
you
now.
are
Okay?
now, right? Yeah,
Yes.
that's it.
One more thing I wanted to bring up about reporting season before we move on, and that's that the market's been very quick to anoint a handful of, well, more than a handful, a whole segment of winners, and their share price has soared. And it makes me worry that um, the market doesn't seem to be distinguishing between a genuine structural change in growth and a pull forward of demand. So you look at the valuation on, say, JB Hi-Fi, Harvey Norman, that to me is clearly a pull forward of demand and not a structural change. Whereas something like NextDC or Macquarie Telecom or Whisper, quite possibly a structural change. And yet there's not much difference in the way the market's treating those two stories. Have you guys, do you have any thoughts on that?
Yeah, I'd agree. I mean, yeah, I guess there's some permanent beneficiaries, and then there's some that are maybe benefiting more from a one-off hit, that are kind of benefiting from having their competition shut down, or from everybody locked up at home. I guess whereas if you're a business that can capture customers and keep them around for the next 5 or 10 years, then that's really valuable. So. Um, yeah, it's just about distinguishing and kind of, I guess, deciding which is which, really.
Well, and it's also the underlying thing about interest rates. So what this is essentially, all the concerns about interest rates ticking up have gone away now, and that does make long-term growth very valuable. And I suppose the market's chasing those stocks to pretty crazy levels in a lot of cases, I would say. But so there's been that effect as well as the reporting
Yes,
season.
quite right. Yeah, this liquidity impact, yeah, hard to measure, but definitely not hard to ignore. I guess the difficulty is trying to do the reverse of that as well, is trying to find the stocks that have fallen but won't have a long-term impact. Hang on a second, my wife's on the phone. Hey, Croops! Oi! Shh! Come on, call. I can literally hear every word you're saying.
Jeez, if I talk to Sarah like that.
That's good.
He's just walking around the house yelling. Jeez. You know what happens if I do that? Walk around the house, yell? I get thrown out of the house as well. All right. Oh yeah. I guess that the trick is to try and find the reverse of that, to try and identify a business that has fallen but won't have a permanent impact, and the impact is just short term. Which is the perfect segue, Mickey, for the next stock under discussion, which is Vista Group. Now, tell us about this company and why it sits on our buy list after, I must say, a little bit of to and fro within the team.
So Vista Group is the parent to 8 movie and global film related software businesses, and so it caters essentially to kind of studios, to distributors, and all the way to exhibitions, so things like cinemas. Um, it's had a bit of a rough ride, obviously, with uh, cinemas shut down, and obviously that's had a big impact on their customers, and so they've had to provide a lot of support to their customer base, and that means that they're not really collecting much revenue at the moment. And even prior to that, this had kind of been one of those unloved. It was kind of in the naughty corner, if you want to call it that, because of
Was it unloved, Mickey, or was it crappy?
well, I don't think it was ever a kind of a crappy business. I think it was just it had fallen out of favor. It had kind of gotten up to 80 times earnings, and it was growing revenues really consistently, like
Wow.
15-20% a year.
Mm.
And then they announced a couple of lost customer wins that they thought they were going to get, and they announced a transition of the product from legacy on-premise software to a software as a service model. And then obviously what happens then is that, people begin to realize that earnings growth is not going to be what people thought it was. And so you've had kind of this bad news on top of bad news type of situation. And so the share price is probably about 80% or 75% off the highs. I guess what was attractive about it though is it's just very dominant in its niche. It's got massive market share. Something like over 51% of cinemas use this software globally, excluding China, which is a huge market share. So that by far the biggest. And if you think cinemas are going to be around in 5 or 10 years, and I think that they will be, and I think that people will come back to cinemas pretty quickly as soon as they're allowed. um, then this is the market leader, and they're the strongest player, and they're probably going to use this period to pick up market share and emerge as a stronger business on the other side. So there are definitely some risks in the short term, and I think they're burning some cash at the moment, but it's more of a I think if you take a long term view with this one, then hopefully it's going to do well. So
I think people are sure to go back to cinemas. I mean, it's a different thing. It's one thing, it's easy to say people will sit at home and watch Netflix, but I mean, people eat food at home as well, but they're still keen to go out to restaurants, and it's an experience, isn't it? And it's a bit of fun. It's a bit different, in that you get a much higher quality than you could possibly get at home. My concern about the stock is that sometimes this sort of thing where it slows down the incumbent or the first mover or whatever. It enables other people to catch up, and I just wonder whether it just increases the risk that a chain of cinemas or someone else makes their own software, or just this slowing down of the major player just enables someone else to get a foothold. I mean, perhaps the argument is that now's the last time. They're not really not gonna be bothering with that sort of thing at this moment, and I suppose that's the argument. But that's what creates the uncertainty for me.
Yeah, I think though the thing is with this, well, there's two things I guess on this front. So one is just that the industry is so beaten up right now that I find it hard to think that there's going to be a new entrant. So there could be existing entrants that try to take share, but I think Vista, for example, is probably one of the only it is the only publicly listed cinema software provider. So they've been able to use this period to raise capital. I think their smaller competitors and more regional. There's no global competitor like Vista. So they've got very small competitors in South Korea and parts of maybe like Poland and things like that. But they're not as well capitalized. They're not as big. They can't go out and raise money. So I think it's just going to be harder and harder for those for those companies to survive relative to Vista, which has just raised capital. It's got plenty of cash on the balance sheet. It can invest in its product. It can keep rolling out new features, and I actually think it's going to go the other way, where they're going to be taking share off those smaller players. So I think um, the the industry at the moment is not attracting new entrants, and I think these guys are just going to be the strongest, and they're going to be able to take share off those smaller players.
What about a cinema chain making its own? Is there a chain that I feel as though there's a chain that has
Yeah.
50% of the world's cinemas or something like that? Is that
AMC,
right?
right?
Is that I
No.
don't
Well,
know what the
AMC doesn't have that many.
Isn't it the biggest one though?
what sort of
y-
what sort of share are we talking about? Is it? I mean, it's
uh,
20,
um,
30.
no,
Yeah,
it wouldn't be that high. I mean, it might be
right.
10-15%, I guess.
But is there a chance that they would make a competing product? Do they use Vista's product?
I'm not sure about AMC specifically, but it has most of the large chains on its software.
Right.
But there are cinemas that use the software, but I think, that create their own software. Um, but the difference is that Vista has it can provide software to more screens, and so you're spreading out the development cost across a wider customer base. And so if you've got 60,000 screens that you can spread it out to, that actually increases the amount that you can spend on the software, and actually improving the software relative to someone who owns 10,000 screens, and wants to do it all in house. And I just think it's a different business function. And yeah, so I don't see that as a massive threat. Realistically, I think making software is a distinct business from actually running a cinema.
So I suppose it depends on how sophisticated the software is and how much of a benefit there is in terms of because it does more than just sell popcorn, doesn't it? I mean, it anticipates demand. It builds your website for ticketing and all that sort of thing. You'd be able to say better than me, but it
Yeah.
does a whole heap more than just the
Yeah,
basics.
yeah. I mean, and analytics and things as well. I mean, they can see, give you advice on which movies will perform well, things like that. So, I mean, it's all facets of the business. I think, like, recreating this kind of software wouldn't be easy. I think it would be, and also you got to think, like, the cinemas right now, the actual chains, they're the ones who are actually under even more pressure. So how they're gonna find the money to go out and build a massive software
Mm.
product right now is, if Vista can't do it, then I
Yeah.
don't see anyone else that can.
Well, and of course they're building in they're currently investing in a cloud product, or they're about to release, are they? And so that presumably will have advantages over the typical sort of installed software. Is that right?
Yeah, so the cloud-based product should just allow them to roll out new features quicker to their customers, and also actually take on feedback more quickly as well. So whereas at the moment, if you've got an on-premise cinema software, you've got an IT team that's actually sitting at the cinema, and when you need to update, your software, if you're a chain with, 5,000 sites, you've actually got to get somebody to go out to a physical premise and actually update the software, um, which is a huge task. So there should be just benefits in terms of how quickly they can roll out improvements and updates. And
And there's a
and yeah,
long runway of potential improvements. I suppose that's the main thing, because then if you got a good cloud product and you can keep improving the software to bring benefits to customers, then that's really what's going to keep out the competition, isn't it?
yeah. I think
And
there's
build the economies of scale.
yeah, yeah.
Mickey, I remember people saying for years that cinemas are dead. I've heard it for about 10 years that, the people don't go anymore, young people don't go. And that really, I'm not sure if that's borne out in the numbers. I follow Events Group pretty closely, and they make very good returns from their cinema business. And I believe the number of screens in the Western world has held pretty steady for many, many years and grown very strongly in China. So I wonder if the thing that's different now is the advent of streaming. Can you talk a little bit about how streaming might change and challenge the cinema business? Do you think that's the case? Just for some context,
Yeah, yeah.
I noticed that Disney is releasing a couple of their new movies directly on their streaming service, and when they do that, they make multiples of their money for every streaming customer compared to a customer who sits in the cinema and watches that same film. So the incentives seem to suggest that they'd rather stream their movies rather than send them to the
Mm.
cinema.
Yeah, I mean, it's certainly possible for Disney because I guess in Disney's case, they're trying to win customers onto their platform right now.
Hmm.
And they're kind of in a battle for market share. And so maybe the incentive is to release it direct just to to actually just capture customers onto your, um, I don't know what they're calling their new um,
Disney Plus. You
Disney
clearly don't
Plus.
have young children.
No. So yeah, so just as a way to attract, but I think the economics longer term probably won't really justify it because if
Hmm.
you're a Disney Plus customer
Yeah,
and you're paying, 15-20 bucks a month, and
actually
then
like
you've
$8 a month. But yes, continue.
oh,
Think I
sorry.
can see the point you're making. Yeah,
Yeah, I mean, wouldn't you just wait the extra
yeah,
60 or 90 days to
yeah.
watch it for free?
That's exactly what I'm doing because they're
Yeah.
charging $35 for the new film. You can either pay that and watch it now with the same experience, right? Same TV, same couch, or you can, as you say, wait probably 30 or 40 days and watch it
Mm,
for no additional charge. Same
yeah.
movie, same film, same screen, same couch.
Yeah.
Yeah, for the
Yeah.
customer, the cinema seems to be a much better deal.
Oh yeah. I mean, well, if you're gonna pay $30, I mean, you'd rather go see it on a big screen, I guess.
Absolutely.
But
Yeah.
I guess the only difference is maybe you can spread it out over a whole family. You don't need to buy 3 or 4 tickets or whatever.
True.
But you know,
I think it's the difference is that it's just it's an event, isn't it? Going to the cinema is, I mean, kids love it. It's it's an outing. You go and have a meal, go to the cinema. It's a whole I mean, to compare that with sitting at home watching something on streaming, to me is apples and pears.
yeah. Who's gonna want to sit at home watching a movie after all this? I mean, isn't everyone keen to get out of their houses? I mean,
Yeah, I think so.
Mhm. So, does the investment case here really just fall to the success of cinema in the end? Because these guys have a very big market share. It's pretty hard for competitors to catch up, and they're not likely to pour money in. Is it just about whether cinema survives?
yeah. Well, I think that's a part of it, and then also just that this is, yeah, as you say, this is the market leader. I think they can kind of continue to take market share, even though they're already so big. I think that they can probably keep growing that, maybe by maybe a percent or two each year. So I think ultimately this is just going to be in 5 years, once they've completed that transition, this is going to be like every other software as a service stock, and people are going to remember that. And then hopefully the share price is higher than it is today. So that's basically it in a nutshell, really.
JC, any other thoughts on that?
No, sounds
There
good.
was a lot of discussion about that one. I think I don't know if it divided the team. I think we all came around eventually.
Yeah, I
But
don't.
yeah,
Yeah, exactly. I think it was. It's just. I think a lot depends. It's one of those ones. A lot of these software companies are quite
mm,
difficult because you don't get to use the software yourself. It's hard to know the level of sophistication, and I think the level of sophistication is crucial because that's what keeps the competitors at bay. That's what means you have the economies of scale, and you keep investing, and you make it better,
Mm,
and that's what keeps the competition at bay, even despite this hiatus. And so I suppose it's hard to gauge that level of sophistication from the outside. But I think you have to sort of make a judgment about it sometimes, and
yeah,
um, I think it's
it is
pretty
one
good.
of the challenges with software businesses, I guess. Like,
Mm.
so on a side note, I was just quickly watching the ASX small and mid cap technology presenters, and every software company is growing revenue at 30%. They're all got these amazing outlooks, and it's massive addressable markets. It's
the
like
TAM. You got to mention the TAM.
it's like they're just all just kicking goals. It's so hard to differentiate between
Mm,
them. Um, so yeah, I don't know what that means, but maybe it just means just buy software, and I don't know.
nothing else.
Hmm.
Yeah.
Yeah, Vista was interesting. I quite like the idea. I like the exposure to the recovery because I can see good reasons why no one is buying it now and why investors would stay away from it. Um, One of the things that concerned me was that it's got a very big market share. As you say, over 50%, and yet the business is only sort of $200 million. So, to get bigger, you either have to charge your existing customers more or take even more than half the market, which can be challenging to do. So I think the downside here is quite low, very low, in fact, and I guess you get really good optionality on the cyclical recovery. But as a longer term recovery, I do wonder how much. I mean, probably not a stock I'd own. I'd hold for 5 years plus.
Mm. Yeah. Well, I guess it's not one of those companies. It's got you know, um, one of those addressable markets that's just kind of infinite. But having said that, it can still charge more to its existing customers, and it can
Mm.
still keep taking market share and adding a few percent here or there as the market grows. So,
And the
yeah, I think,
valuation is quite attractive
yeah,
at this price. It does look quite interesting.
yeah.
Hmm.
So,
Okay. We've got another stock actually for the recovery, and JC might bring you in for this one. A favorite of ours that we've recommended many times over the years and generally done really well out of, in fact, which is Flight Centre. And I had a quick peek at the share price quite by accident the other day, and I noticed it's like $13, James. This thing has really bounced back. I just wonder we all kind of
Well, it was
know.
17 in May or something. It
Oh,
got
was
down
it?
to sort of
Right.
8, or it got down
Yeah.
to 8 or so, and then bounced to 17, and then it was back to 10, and it's been all over the shop, which
Moved
is,
around a lot, yeah.
yeah, not surprising, I suppose, in some respects.
Yeah, I mean, this travel has seems to be the barometer for sentiment about the virus generally, and where goes sentiment, there seems to go the stock price of these things. How are you thinking about these travel stocks now? Because I do wonder whether they have a lot of the recovery priced in. The market caps after the very hefty capital raisings are actually a bit larger than you might expect. Has the recovery already been priced in?
I don't think so. I mean, the question is, I mean, look, I think you've got to look beyond the pandemic. Obviously, the pandemic created existential risks for a lot of these stocks. Consequently, they raised money, um, and I think that they've raised enough to get them through to the other side. Flight Centre, even with pretty much no revenue, should be able to get through to the end of next year. Um, and by then, you'd think people would be moving around, at least within their own countries. And for
Not
example,
if Queensland's Premier has anything to say about it.
well, yeah, all right. Well, at least within
Yeah.
Queensland. I mean, but yeah, look, I mean, that's Australia. I mean, so
Mm.
so the corporate business, which is
Mm.
from memory about a third over in the US, and that's I think 60% domestic travel. And look, I mean, I think in the rest of the world by the end of next year, with or without a vaccine, I think that they're going to be pretty much through the other side of this because of the immunity that they'll have built up. Um, so I think people are going to be moving around but certainly, probably by next Northern Hemisphere summer, I would think.
Mm.
But that all remains to be seen. But I think, I mean, it's conceivable they have to raise capital again, I suppose. But if you look beyond all that, Flight Centre has an attractive business, which is particularly the corporate business. I think the leisure business, we've all uh, begun to accept that. I mean, that's pretty compromised by online travel agents.
Mm.
But the corporate business actually has something to gain from technology
Mm.
because in terms of managing budgets and booking and all that sort of thing. Um, there's benefits from technology for companies having their travel managed by someone, and so I think that that's got a long-term growth story to it. And I value those profits quite highly on the other side of the pandemic. The interesting thing about the result last month um, was that where previously they've said that they made about half between leisure and corporate profits, they actually came out and split that out and said that it was actually more like two-thirds, one-third in
Mm.
2019, which actually makes a huge difference to the valuation if because we place a higher multiple on the corporate profits, and so given that they have a higher share, that boosts up the valuation. So I think it's entirely rational that the shares have increased a bit since before the result. Um,
Does the
and
corporate business concern you? Because a lot of companies have now gotten used to limited travel, and they've invested in video conferencing. And has behavior changed enough to shrink the market for corporate travel?
Well, maybe a little bit. I mean, the scenarios that we put up an article in, what was it, July, I think,
Mhm.
and put a couple of scenarios. One where the corporate, so post pandemic, we had it shrinking by 30% in our bearish scenario and shrinking by 10% in the bullish scenario. And I think that's realistic. I think it's a long term growth market, though. In Australia, for example, only about half of corporate travel is actually managed by anyone at the moment, and I think that technology can add value to that, and I think that share of the market will increase.
Hmm.
Um, so I think that there's a long term growth story there.
James,
Mi-
do you reckon? Well, I don't think there's any doubt that travel will eventually. Well, there is doubt, but I mean, I'd also agree that travel will probably come back. I think people are pretty keen to get traveling again, but like, what concerns me would probably be the capital raising or the need to raise capital. Do you reckon that they're do you reckon what kind of scenarios need to play out if that for them to potentially raise capital from here?
Well, they've got roughly till the end of 2021, calendar 2021, making barely any revenue. Um, so um, I think if they make absolutely no revenue, it's about September next year. But making the sort of they made 17 million in July of revenue, and travel is ticking along. I mean, essential services are still traveling, and a lot of those government organisations have their budgets, their travel managed by someone. So that's ticking along, and I think that's probably going to increase, especially the domestic travel. I mean, obviously, we're viewing it from. I mean, Graham Turner actually said this on the chief executive. That is, said this on the call. That Australia has very conservative settings for the pandemic compared to the rest of the world. So it's very easy for us to sit here and imagine no one traveling at all, because that's pretty much how it is for us. But in Europe, people are going on holiday. People are traveling around. They're going to different countries.
I can imagine there's
Um,
probably tears in Mickey's eyes at this point.
yeah, well, I mean, look, it's a different approach,
Mm.
but that's what's happening. And look, it's probably going to get a bit harder in the northern hemisphere over winter. Would be a reasonable guess. Um, but ultimately, they're showing I mean, I suppose the bird has flown in some respects. It's we're adopting the settings that we're adopting because we've got the virus so well contained. It's so rife, I suppose, overseas that there's less benefit in trying to suppress it aggressively.
How do you think a proper recession affects these recovery stocks? I wonder, because we've had kind of in this artificial period right now where we're getting all this stimulus. It's almost like by the time these businesses start to recover is actually when all that's gonna start rolling off. So I wonder, when we actually get that, people going to be traveling as much or even going to the cinemas or doing anything.
Yeah, I
Um,
think I think that's right. I mean, overlaid on all of this, you've got to anticipate the economic impacts. But we're talking about, um, you know, lopping 30% off travel budgets in the corporate sector. When you're talking about those sorts of things, a bit of a recession here and there and a reduction in demand of a few percent doesn't make so much of a
Mm.
difference, doesn't it?
mm, true.
I mean, they're priced for pretty bad scenarios. Flight Centre, Webjet, the travel stocks generally. So, no doubt economic weakness it would have an impact as well. But I think if we get travelling again, that's the least of our concerns, really.
And JC, what would be your pick for the best looking travel stock? What would you buy out of that area today?
Well, I would note that. Well, I'd say a couple of things. Uh, they're both Flight Centre and Webjet are both basically bang on our buy price at the moment. They're just
Hmm.
sort of wobbling around there. $4 for Webjet and $13 for Flight Centre, and I'm sort of reasonably comfortable with those. Uh, with those buy prices. So I wouldn't be. I mean, they're yeah, basically one or the other really. They have slight differences. Webjet is more focused on the hotel bed bank business.
Mm.
Um, so there are differences. Um,
Mickey, what about you? Same question.
Well, I'm not sure. I mean, I was probably going to ask the same question. I've looked at the sector and I'm pretty interested in it, but I'm not sure if the best way is to pick one or just to diversify across maybe a basket of them. And
Yeah, I mean, I think that's I hold Webjet and Flight Centre, I should say, and we've said. I mean, I think they're both. I might be wrong here, but I think that we have 3% portfolio maximum weightings on them. But if you hold both, you probably want to, you probably wouldn't have the full 3% in both. So, maybe 4 or 5% if you spread your money across each. And I should note that they're both speculative, given that they're not making money at the moment by a long way. So, um, yeah, I mean, I think they're both pretty good opportunities.
Yeah. Well, we've known Flight Centre for a long time, and that corporate business has been hidden in Flight Centre for a long time. So,
Well, it didn't. You see, this is the thing. When we were, I mean, we've recommended it on and off for years, and as you said at the beginning, done pretty well out of it. But 10 years ago, this corporate business barely existed.
yeah, yeah.
And so the argument 10 years ago was all about online and the incursion of online and whether bricks and mortar travel agents were doomed. And during the GFC, it got down to about $4, I think, because at that time, they had a bad year. When Flight Centre has a bad year, it looks very, very bad. It misses its overrides and the profits come crashing down. And when the bears get their honey, they get very overexcited, and you get all the stories coming out, and everyone was, the whole internet thing was getting a lot of airtime, and actually that has proved pretty accurate. The bears have probably been right about that, but the difference is that, I mean, at the same time they built this corporate business, which has really saved them, I think.
Yeah. I've always been a bit uncomfortable about Webjet. It just it because it's a reseller effectively. I mean, I understand the points about collection and integration with all the suppliers, and it seems to be well managed as well. It's done very well. But I would probably prefer Flight Centre. And I must say, I quite like Qantas at the moment. You guys all laughed at me when I mentioned that at the meeting. But
I'll do it again.
and maybe that's good reason. Maybe I need a good
We
whop over
wrote
the
an
head.
article years back. Was it about Rex or Virgin
Hmm.
or something? Um, about, what is it, Aeroholics Anonymous, which is what Warren Buffett talked about. Whenever he thinks of buying an airline, he gets on a phone, I think probably to Charlie Mungo, who tells him something so stupid. And yeah, well, I think you need that number. Go
Yeah, I
ahead.
might need that
No,
now.
look, it's got the the frequent flyer business, hasn't it?
Yeah.
Which is a very good business, and
And so is that domestic airline business. They actually make very good returns from domestic travel. Um, International business, I grant you, is not great, but most of their profit actually comes from frequent flyer and domestic travel. You got a huge cost cutting drive, and the best excuse ever to remove costs you probably couldn't do under normal conditions. And then you've got very low fuel prices. You've got a competitor that's out of business and kind of struggling to scramble planes together to compete. And I think on the other side of this, you're going to have the biggest bounce in demand in history. I mean, can you imagine what happens when restrictions are lifted?
but if
Everyone's going
that's
to
the
go
case,
everywhere.
then you'd sure. I mean, well, look, if that's the case, then I'd rather be in Webjet and Flight Centre.
Really? I don't know. I think I'd
That's
rather be in the more
and or Sydney
leveraged
Airport. I mean,
Sydney
the
Airport. Yeah.
I don't
Yeah.
know that Qantas is more leveraged. I
Uh,
think that what's the upside for Qantas?
well, they've
Is it
got a
double?
big fixed asset base,
Yeah.
and
I've,
that's got to help.
I'm not used to hearing that described as a plus point.
It is a plus when you're expecting a big lift in demand. I think that's operating leverage working really nicely.
Yeah. Okay.
Yeah,
I mean, I
but
don't.
I take your point that the others, well, certainly Flight Centre is a better business. I
Yeah.
I am not quite sure about Webjet
Well,
yet.
the thing about Webjet is that I
Mm,
think it solves a problem. The
yes,
hotels need some way of getting
yes, I
their.
think that's right.
There's a lot of hotels, and they need a way of getting their inventory to a lot of travel agents. And there are different ways of doing that, and there's various channels for that. And the bed bank seems to be a very efficient way of doing that.
Mm,
And so that's the argument for Webjet. And I think I think it holds water, and I think that there's ways that they can improve that, by cutting out mistakes in booking and that sort of thing.
The challenge though with Webjet though, I mean, I think we talked about this, but it's just with the share price where it is. I mean, they're kind of relying on continuing to make acquisitions and rolling up that bed banks
Oh, I
business.
don't think they
guess.
need to make acquisitions particularly.
To keep taking market share though, right? Or
Well, I think that,
isn't
I
that
mean,
their
if you
kind of
make an
strategy, or-
acquisition, you increase your market share, but I think that you can increase it without as well. I mean, they're the number 2 player, and but about half the size of the number 1. So, but they're what is it, 5? They're about 5%, and the number 1 is sort of 11 or 12 or something.
So is that
And
not
so
not an
they're both
important?
very small, relatively. It's a fragmented market. But if you do a better job than other people, you can increase your market share without necessarily acquiring other companies.
That hasn't been the case for Webjet historically. They have
Well, I
grown
think they've
by,
done both. I
yeah.
mean, they've
Yeah,
been
you're
buying
right. Actually,
businesses, but they've also been getting a lot of organic growth. I mean, that's the argument. I mean, that they would say that an increasing share of the of hotel beds around the world will go through bed banks in the future.
Well, can we say this? Can we say that I get Qantas? JC, you can have Webjet, and Mickey, you can have Flight Centre.
Oh, geez, all right.
We'll
Well,
divide it up. I'd be
yeah.
happy
Very,
with that.
very happy for you to have Qantas.
It is good though. I think, or of like with Qantas. I mean, it's good. I don't think it's ever good to be too dogmatic about things. And like, if you look at Warren Buffett, like he's just bought this tech business. I don't really know too much about it. It's called Snowflake. It's like the most un-Warren Buffett-like stock I've ever seen.
Is it actually him though, or is it his
Well,
sidekicks?
yeah,
because
I don't know.
it's a bit hard to tell these days, isn't it? I think.
Does it
Yeah,
matter? Is it if it's his sidekicks? Is
but
it
I'm
still
sure he
Berkshire?
Oh
gets.
no,
He can pull rank. I
it only
mean,
matters in as much as you can't say that it's
Okay. Yeah.
him departing from his,
Right.
well, I can't see Berkshire of 15, 20 years ago doing something like that. I mean, or 10 years ago even.
no.
Finally, senility has snuck in.
Yeah, this will be the time when the tech bubble crashes for good. No, but yeah. So I mean, you never know. Qantas could be the next.
Well, he sold all his airline stocks, didn't he? But I don't think they all had frequent flyer businesses.
Or domestic monopolies.
He's sold them all in March. I mean, I think, didn't he? Pretty much at the bottom.
He did.
I'm not sure I got that completely
Sold
accurately.
airlines at the
I
bottom and
think
bought a tech stock
At the top.
he'll be dusting off his Rolodex and finding that number for
Oh, dear.
Aeroholics Anonymous.
I might get that card off him if this goes pear shaped. But there you go. All right, gents. I think we're starting. I think it's probably pretty obvious. We should probably roll this up.
Rambling a bit.
Yeah, rambling a bit. JC, thanks for joining us. Thanks for your time.
It's a pleasure.
Mickey, take care of yourself over there. Thanks for joining us.
Cheers. Thanks.
For everyone else, thank you for listening.